Good afternoon and welcome to another edition of Money Matters. My name is Dan White. I am the host of your show. I'm also the president and chief executive officer of Daniel A. White and Associates. We are a retirement planning firm headquartered in Glen Mills, Pennsylvania. We have satellite offices in Middletown, Delaware, and also down in Lewis, Delaware. And I guess the big news today is the stock market. You know, it seems to just be jumping all over the place. And I was joking. I said, you know, as they say in the airline industry, you know, where the seatbelt sign is on, please, we are experiencing some turbulence. So please return to your seat and buckle up. It may be a little bumpy before we land. And that's certainly true of the stock market today. What we've seen in the past week is really kind of unprecedented. We turned what was a kind of a garden variety correction for the benchmark S&P, which means it's down 10% from its previous all-time high. It very quickly morphed into a bear market, which is a 20% drop. That's considered a bear market. So, you know, and this is in the course of a week. I mean, it has really been startling to see how quickly the market has reacted. And it's hard to chalk it all up to anything other than, as Donald Trump called it, Liberation Day. President Trump's announcement came after market hours last Wednesday evening of a blanket 10% tariff on all U.S. imports and significantly higher rates on many other countries intended to eat away at the U.S. trade imbalances. And after that, the S&P 500 dropped 10% plus in 2 days for just the fourth time since 1952. The other times were October of '87 with Black Monday down 20% in one day, November of 2008, the great financial crisis, and then in March of 2020, the start of the COVID pandemic. Well, now we can add the tariff tantrum to that short list of big drops. Now, Trump says tariffs are going to generate hundreds of billions, if not $1 trillion in revenue for the U.S. over a very short period of time and really boost our economy. And, you know, I hope it does. But, you know, a couple questions. You know, what's the impact of tariffs on businesses like Apple and Nike, which are now confronted with perhaps a 54% higher cost on goods made in China than just a few months ago, and multiply that across various industries? A lot of people say tariffs are just going to increase the cost, you know, inflation, the cost to the consumer. They're just going to try to pass it on to us. So, you know, it remains to be seen. This has all happened literally in 7 days that we've seen this big drop. And now this afternoon, you know, Trump has kind of backpedaled a little bit. He's pausing tariffs, and what's happening? The market is just rocketing back up. So it was a very, you know, a very short thing here, but it's coming back. So I think the moral of the story and what we've been telling our clients and the way we structure financial plans for retirees, I mean, you got to have different buckets. You have to have a safe kind of an income bucket, money that you're relying on for spending. And then you got to have a growth bucket. The growth bucket should be, if we've done our job correctly, the growth bucket, you shouldn't panic. You're not using that bucket for income or necessary expenses. It's more or less your inflation hedge. And over time, we know the stock market will outperform every other thing out there. So if you have time on your side, you want to be in that growth bucket. If you need the money in a shorter period of time, either for income, some big expense, a new home, something along those lines, that money should probably not be in as much of a risk position as perhaps money that you have a longer term time frame on. And that's just you know, kind of prudent that we see that. So that's kind of what happened in the last week. And you know, when's it going to end? I mean, it really, you know, you don't know. I mean, Trump, I mean, the word on the street was that a lot of countries were lining up to talk to President Trump about the trade imbalances, about the tariffs. And, you know, there's so many variables here. I mean, if he makes agreements with countries, the market will go back up. I mean, this, I think, was strictly kind of all about this tariff, and we're going to talk about that with our guest today. But I mean, if he makes trade agreements with countries, if they pass a tax bill, which it just passed in the Senate, goes to the House now. If they come out with a tax bill, that'll send the markets higher, because basically the stock market does not like uncertainty. And what we have had in the past week, I mean, everybody knew the tariffs were coming, but he paused them once. This was Liberation Day, and now he's kind of paused them again. So it all depends what side of the bed President Trump wakes up on, and what he says he's going to do regarding the trade imbalances going forward. So, as I said earlier, fasten your seatbelts. I think there's going to be a lot of volatility, both up and down, until we see this thing come to fruition. So that's my 2 cents on the last week of activity in the market. And I want to introduce our guest today, Vahan Janjigian, PhD. Vahan is the CEO of Greenwich Wealth Management. Hey, Vahan, I want to welcome you to the program this afternoon.
Thank you, Dan.
I don't know if you heard my dialogue there, but it's it's been an interesting week in the stock market, shall we say?
Yeah, tremendous volatility. It's not unusual to have this kind of volatility. We've seen it before, but what's very unusual this time is that it was entirely man-made and completely avoidable.
Yeah, when you think about it, we haven't seen this type of volatility since the pandemic. The pandemic was obviously, I mean, some might argue it was man-made, but it wasn't intentional. Let's put it that way. And this, like you say, everybody thought, oh, the economy's humming along. We had the Trump bump after the election, and stocks and all were up. And then in the course of a week, man, all heck broke loose.
Yeah, you're right. This is very unexpected. Everybody thought that Trump was going to be the pro-business president, and that the stock market would do really well, like it did in his first term. Yeah. And we did see a bit of a run-up right after the election, but since Inauguration Day, things have been very bad.
Yeah, they have, and I guess the more before this rally today, when he decided to pause things, we were down pretty good year to date.
We were down about $14 trillion in stock market value, which is a hell of a lot more money than any of the jobs that he hopes he can bring back to the United States will be worth.
Yeah, absolutely. So. And as I said, it's you don't know what's coming next. I mean, we're up big today. Tomorrow we could crash again. Who knows?
That's right.
It all depends on what he tweets and just the communication coming out of the White House. We do have a question from one of our listeners today, Norman Rogers of Boston. He writes in. He says, "Is this a good time to buy oil stocks?" What are your thoughts on that, Vahan?
Well, I'm glad to hear he's from Boston, because that's where I am. So I actually do think it's a good time to buy oil stocks. I'm always in favor of buying things that are out of favor. My view is that oil prices have come down tremendously for a couple of reasons. One of the reasons is that there's an expectation we will go into recession, and therefore there will be some demand destruction for oil. However, I do think we are going into a recession, although that recession may not be so severe. And as a result, because prices are way down and some oil stocks are way down, especially companies that do exploration and production, I think it's a good time to buy those kinds of companies.
Yeah, it's kind of interesting. We talked about this a little bit before we came on the air, and I made the comment, and you said you would use this in a book you had written, that our industry, the investment or the retirement industry, if you will, is the only industry where people are afraid to buy when things are on sale.
Exactly.
If the car dealer down the street said, "Hey, we got a Mercedes-Benz and it's 20% off," people would be all over it. But in the investment business, when things are down 20%, people don't want to go near the markets.
That's right. It's an odd form of human behavior, but you're absolutely correct. That's what happens.
And like you said, yeah, they don't have any problem buying at the all-time high, but they're afraid to buy when things drop a little bit. It's kind of counterproductive.
Yep.
So, well, we've got a lot of list of questions here that I want to dig in with you because I'm really excited to hear your insight. I mean, President Trump is talking about, and again, if you look at his numbers, other countries apparently have been putting tariffs on the U.S. for decades, and which helps, us run a trade imbalance. What exactly is a trade deficit, Vahan?
So, yeah, a trade deficit basically means that you are exporting less than you're importing. Which shouldn't be surprising for a wealthy country. I mean, we are the richest country in the world. We do have the largest economy. So it only makes sense that we would want to buy more things from other countries than they would want to buy from us. So it should be no surprise to anybody that we have a trade deficit. The more important question is a trade deficit a bad thing? And it's not. Donald Trump has never been able to coherently explain why a trade deficit is a bad thing. Now, when a country places tariffs on us, what they're really doing is they're making our goods more expensive to their citizens. Now, trade tariffs sometimes do make sense in a very targeted way in order to protect certain industries, especially to protect things that are of importance for national security. But imposing a trade tariff, for example, on a country like Colombia that produces coffee makes no sense. It's not like we're going to grow coffee in the United States. We're not going to grow bananas in the United States. So these kinds of tariffs make no sense. All they do is increase the cost for American consumers.
Yeah, it's interesting you say that because the other part of Donald Trump's program, which I don't think anybody seriously would disagree with, is that we have to shrink the size of the federal government. That you can't keep spending $2 trillion more than what you bring in. Makes good sense, but again, it's not necessarily the concept or the idea, it's the implementation. Do you have, you don't want to lay off all the nuclear engineers, right? And some of the industries that he is dismantling. I think if you have a more targeted approach, it would probably be more appeasable to the American public.
Well, I always tell people don't confuse the trade deficit with the budget deficit. I mean, the budget deficit is a bad thing because that increases our national debt. So we do need to get the debt under control. We need to stop running budget deficits. And you're right. The way to do that is to run the government more efficiently. But mass layoffs like they've been doing lately, finding out that they laid off people who control our nuclear facilities and then having to rehire them because they realized they made a mistake. They need to be much more careful, but I'm all in favor of reducing government spending.
Yeah. So why does President Trump believe trade deficits are an issue for the U.S. and why does he think other countries have been ripping us off?
Well, the only thing he's been able to say is that a trade deficit is proof that they've been ripping us off, but it's not. They're not ripping us off. We're buying things from other countries because they can produce them for less than we can produce them ourselves. We should be grateful for that. I recently gave an example in a letter to my clients, and I said, my wife and I, have been shopping at Costco for years, but not once has Costco ever purchased anything from us. So you could say we have a trade deficit with Costco. Should I impose a tariff on Costco so everything at Costco costs me more money? How would I be better off if I did that? It's not like I'm going to produce my own laundry detergent or I'm going to put a chicken coop in my backyard and raise my own chickens and eggs. So it makes no sense to punish countries that are selling us things that we want at good prices. Now, I understand that President Trump is upset that some of the manufacturing jobs from the past have left. But he often forgets that, we are a service economy and we have a huge trade surplus with other countries when it comes to services, including China, by the way. And so we've basically traded, lower value manufacturing jobs for higher value services jobs. So yes, some people in our economy have been hurt, other people have benefited. But if you look at the overall picture, the United States is much better off than it was 2 or 3, 4 or 5 decades ago.
Sure, sure. So one of the things that President Trump is always spouting is, oh, the tariffs are going to bring jobs back to our country. They're going to produce enough revenue. We're going to eliminate income taxes. I mean, that sounds like a great idea. I don't think anybody would argue. Is that reality?
Well, first of all, okay, so if you impose the tariffs, it's absolutely true that we'll be able to bring back some manufacturing and some jobs. So the first question is, who's going to fill these jobs when you're also deporting so many people from this country? We have a very low unemployment rate. So where are we going to get the people to fill these jobs? And furthermore, don't forget that we are in an era right now of automation and robotics. So what's likely to happen is that if we bring back the manufacture of certain goods, they're going to be manufactured by robots, not by people. So that's not really going to help anybody. So yeah, as far as the taxes go, Trump has often argued that he would like to eliminate income taxes and replace them with revenues from tariffs. But if that's the case, why is he negotiating with other countries to lower tariffs? Because then you're going to reduce the revenues that you're getting from the tariffs. So yeah, it's kind of odd to be arguing that the tariffs are for increasing revenue, but at the same time, they're to bring back jobs to the United States.
Yeah. So, I mean, it kind of sounds like you're not buying everything he's throwing our way.
No, I'm an economist at heart, and I understand the law of comparative advantage, and I think that tariffs are a big mistake. And throughout history, every time tariffs have been imposed, they've been a very bad thing, and they were a major cause of the Great Depression that we had here in the United States.
Yeah, I know. I've read some of that history myself. So long-term interest rates have been going down, and I know Trump. That's a kind of a little side view, if you will, that he wants to get long-term interest rates down because, let's face it, the U.S. has to refinance some of their debt. We'd rather do it at 2 to 3% than 4 to 5%. So that's a good thing. And oil prices have been coming down too. So wouldn't that be a positive?
Well, both oil prices and long-term interest rates did plunge because of the expectation of a recession. That often happens when you expect a recession. You do see interest rates come down. But more recently, interest rates have moved back up again because now investors are concerned about who's going to buy the bonds. And there's rumors going around. I haven't seen the evidence yet, but there's rumors going around that many of our compatriots in other countries, especially China and Japan, who are big holders of U.S. debt, they've been selling them. So now the market's going to get flooded with this debt. And if there aren't enough buyers, then rates will go up. And more recently, we've seen a surge in long-term interest rates, which makes refinancing our debt much more expensive.
Yeah. And one of the things I've read recently is Janet Yellen was really the person that really screwed this up. She had 0% interest during her whole term in there. You should have refinanced everything back then.
Yeah, I was screaming that at the time. If interest rates are close to 0%, then why aren't you issuing 50-year bonds?
Exactly.
And the answer that I got is they didn't feel that there were enough buyers in the market to buy those kinds of bonds. But if you can't sell 50-year bonds at 1%, then you probably can sell them at 2%, and we'd still be much better off now than we are.
Yeah, you got this money rolling over, and you're going to refinance it at 4 to 5. I mean, that's a huge number. So, you mentioned the word recession, and I've read different reports on this. Some people think we're in a recession already. Some say we're heading. I mean, if you look at the recessionary signals, the tried and true ones. The inverted yield curve, it was inverted longer than any time in history. The SOM rule with unemployment, right? When we go up 50 basis, when we go up half a point in unemployment from the previous low, that all screams we're either in or going into recession. I mean, what are your thoughts on that?
Yeah, those are all pretty good rules of thumb. But yeah, my view is that we are already in a recession, but we don't know it yet.
Right.
Recessions in the United States have to be officially declared by the National Bureau of Economic Research. There is that textbook definition of a recession, which is 2 quarters of contraction. But that's not the definition they use. They basically look for a widespread slowdown in the economy that lasts for a certain period of time. I think we're getting there. So we'll probably find out about 3 or 4 months from now that we entered a recession sometime in March of this year.
Yeah, it's always backward looking, they'll tell you 6 months later, by the way, we were in a recession.
Yeah.
Right,
the good news, by the way, the good news about a recession is that the stock market tends to rally before the recession's actually over.
Right.
So when you see big sell-offs in the stock market, like we've been suffering through recently, those are usually good times to be doing some buying.
Yeah, but I'm not sure that these are your normal sell-offs. I mean, I don't think people are selling off because of economic conditions per se, even though they all point toward a slowdown and slower growth and that type of thing. It's kind of everybody's just blaming Trump at this point for the tariffs. These types of sell-offs, I mean, well, obviously the speed of this is pretty unprecedented to have this kind of drop in a week. But how do you counsel investors when something like this is going on?
Well, what I often tell my clients is that, you should be patient. You should buy more when the market goes down. You should be selling a little bit when the market goes up. And I often have 2 different kinds of reactions from my clients. Some clients literally freak out and they want to move everything to cash. I try to talk them out of it. I have other clients who say, I want to add more, and they send me more money to invest in the market. This is what happened during the pandemic. I had this reaction from 2 different kinds of clients. The ones that went to cash, they didn't come back into the market till the market had already rallied another 20-25%. But the others who added more money were very happy with their decisions.
Yeah. It's funny you mentioned that because, over the years I've done radio shows on this topic, and I know you're familiar with the Dalbar studies, where obviously the average investor does not get the return that the market gives because of emotional. They buy. I wrote a paper actually at one point: buy low and sell high, easier said than done, because everybody wants to buy when it's high. When everybody's talking at the cocktail parties about the latest stock they bought, that's when they get in. Okay, and that's usually when you want to get out.
Yeah, so I tell my clients, look at a long-term chart of the S&P 500. It's going up. Okay, right. So if you zoom in, you will see some periods where the market went down significantly. There are some periods where it stayed low for many years. But, there are very, very few periods of time where the stock market had a negative return over 10 years, even fewer over 20 years, and none over 30 years. So the first question you have to ask yourself is, am I a long-term investor, or is this money that I'm going to need in the near term? If there's money you need in the near term, that should not be in the stock market. But anything that you're investing for the long term, just be patient. It'll come back. You're almost always guaranteed to make money in the stock market over the long term.
Yeah, no doubt about it. I mean, I've said numerous times that in real estate, what are the 3 most important variables in real estate? Location, location, location. Seems like if you're near water, you're going to get a lot of money for your house. And the 3 most important variables in investing are what? Time, time, and time. When do you need the money? If you need the money in 6 months, no, you can't afford to take a lot of risk. But if you don't need it for 10 years, you might be able to get some growth out of that cash.
Yeah, I'll just add one caveat. If your house is near the water, you might not be able to buy insurance anymore.
That's true. I agree with that. Is the advice you're giving your clients today any different than what you were telling them before the sell-off a week ago?
No, it's not. It's not. The only thing I have to do now is a little bit more hand-holding. People are calling me more often, asking me what I think. What I think they should do, what I'm doing myself personally. So it's all pretty much the same advice. If you're getting really worried, then you probably had too much money in the stock market to begin with. You should only invest the money that you can be patient with. And so if you have kids that are going to go off to college in a couple of years, that money should be, set aside in something safer. And I always remind my clients, these days you can get 4.5% in treasury bills, 4-week treasury bills, and just keep rolling them over. That's where your safe money should be right now.
Yeah, it's kind of interesting. You know, I think the government, you know, you may or may not agree, but I think they kind of manipulated the market a little bit after the Great Recession because, you know, keeping interest rates at zero for 15 years is not a normal phenomena either. So people got pushed further and further out on that risk curve, just trying to get yield. And then, of course, it was working because the market did, you know, pretty much had a bull market for 15 years. And, you know, recency bias, people look at through that lens, you know, more than half full. Like, hey, this is just going to continue, and I don't have to worry about risk. And might be a wake up call for a lot of people.
Yeah, remember a couple of years ago, we had a couple of banks fail, including First Republic, and the reason they failed, yeah, the reason they failed is because they had moved further out on that risk curve, and you know, the government basically pushed them there. It wasn't so much that they mismanaged their decisions; they had no choice. If you're a bank, you have to make money, and if interest rates are 0%, you have to take more risk.
Yeah, and I think that's what happened with a lot of people. Again, and we've been programmed kind of like Pavlov, you know, that hey, you know, buy the dip, buy the dip, buy the dip, and that's what everybody did for 15 years. And the other thing that probably happened is, you know, you talk about asset allocation models, and I think for the people I deal with, you know, kind of retirees, kind of risk averse, you know, 60-40, 50-50, somewhere in that range. Well, you know, if you're not rebalancing, you know, next thing you know, you're not 60-40 anymore. You're 80-20, you know, and that's even more of a slap in the face when something like this happens.
Yeah, and I would just remind people that it's actually common for the stock market to sell off by 20%. It happens about once every 3 to 5 years. So though that's the time to really take the opportunity.
Yeah, and if we didn't have the pandemic, let's face it, we wouldn't have had a correction for 15 years.
Yeah.
And again, I think that's manipulation because they were keeping interest rates at zero and printing a lot of money, you know, and that's what kept the economy afloat.
Yeah, the other thing I would stress is that over the long term, value stocks do outperform growth stocks, and that has not been true since 2008 because that's when the Fed drove interest rates to zero and kept them low for so long.
I know value investors have been getting killed. So, is there any particular stocks you favor right now?
Yeah, I do favor value stocks over growth stocks, and you know, a few stocks that I've actually done pretty well with recently are Verizon and IBM. I like them because they do pay very good dividends. These are not the stocks that are going to, you know, double or triple very quickly, like perhaps Nvidia. Yeah. But you know, for long-term investors, especially those who are looking for income, I think these are good things to be in.
Final note here: the Mag 7. Are you getting people off of the Mag 7, or what's your advice on that?
I'm actually getting more interested in the Mag 7 now after this huge sell-off. You know, I was on CNBC not too long ago defending why I had sold Nvidia. Nvidia, of course, is you know, a huge company that's also a major component of all the ETFs. And so for risk control purposes, I didn't think it made sense for my clients to own the stock individually as well as those ETFs. Now that it's come down quite a bit, it is getting a little bit more attractive.
Yeah, well, that's about all the time we have for today, but I wanted to thank you for being on the show, Vahan. Great insight on what's happening. Hopefully we put people, they can sleep a little better tonight with a little rally here today. And we're going to have the next show of Money Matters. We're going to have a guest next week. That is going to be Ken Valyuvani, the CEO of Facet Life Sciences. He's going to discuss a better way to do scientific therapeutic development. So I want to thank everybody for joining us on Money Matters today. I hope you have a great week, and we'll see you next week.